Net income? Profits? Cash flows? What's the difference, and crucially, what should you use to value a company you are considering adding to your portfolio? Hi, and welcome to another episode of Knowledge Unlimited, where we will look into finance and investing today. Remember to subscribe to the channel if you like this video. When investing in a business, it is easy to mix the concepts of net income and cash flows. Why is the difference important, you might ask? It is important because one of the most common ways to value a company is to put a value on the discounted future earnings of the business. The best way to find information about the financial state of a business is to read its annual report. An annual report shall provide information about the company's financial situation and expected development. As the name implies, companies publish the annual report once a year. The annual report consists mainly of three parts: the income statement, the balance sheet, and the cash flow statement, as well as notes. The income statement provides the bottom line that is known as net income, which is the company's annual profit after tax. The income statement must provide an overview of the company's revenues and costs associated with the revenues over the last financial year. The balance sheet can be regarded as a snapshot of the company's financial situation at a given time, and provides an overview of which assets the business has on the one hand, and what liabilities, debt, equity, the company has on the other hand. The cash flow statement shows which payments and disbursements of cash that have been executed between the beginning of the year and the end of the year in the accounts of a business. Before we look in more detail at the net income of a company, it is useful to understand what the net value of a company is. The net value, also called book value or shareholders' equity, is equal to a company's total assets minus its total liabilities and represents the amount that would be returned to shareholders if all the company's assets were liquidated and all debts were repaid. It is important to remember that this is the accounting value of the company, so it is basically the value the company's accountant puts in the company's assets. In this context, the net worth of the business equals assets minus debt. A company typically has lots of assets. Assets equals cash plus accounts receivable plus commodities plus machinery and so on. Similarly, the company has liabilities or debts that take many different forms. Debt equals accounts payable plus wage obligations plus long-term debt and so on. Companies with a positive net worth own more than they owe, and vice versa for companies with a negative net worth. However, it is important to remember that this is the accounting value of the company, and for many companies, the market value, typically the market cap in the stock market, significantly differs from the book value of the company. An accountant does not, for instance, take into account growth prospects of the business. To understand the connection between the income statement and the balance sheet, consider the following. When a company reports $100,000 in annual profit, it means that the company's net value has increased by $100,000. So the annual result in the income statement, the net income, corresponds to the change in the net value on the balance sheet of the company in the last financial year. However, what is important to understand in this context is that an increase in the net value of the company does not necessarily indicate that the company's cash holdings have increased. For example, you can increase the net value of the company by USD 100,000 by an increase of USD 50,000 in accounts receivable. Accounts receivable are the funds that customers owe your company for products or services that have been invoiced, and a reduction of USD 50,000 in accounts payable. Accounts payable, AP, is a short-term debt and a liability on a balance sheet where a business owes money to its vendors/suppliers that have provided the business with goods or services on credit, without changing the company's cash balance. The reason why this is problematic is related to our expectations as investors. When we as equity investors use our hard-earned money to buy shares in a company, it is in the hope that the company, over time, will give us back a larger amount of cash, for example in the form of dividends, than we paid for the share. and we expect this cash amount to come from the company's net profit over time. But if the net profits do not materialize as cash, but for example as a result of increasing accounts receivable, then it will be difficult for the company to pay out this money to us as investors as cash on a regular basis. And in a nutshell, this is the main problem with using net income exclusively when you value a company. Net income tells us little or nothing about how much more or less the company can pay out to investors in the form of cash. And to understand this better, we need to look at the company's cash flow statement. The company's income statement presents the net income for the past year as income minus costs related to the income. However, both income and expenses contain components that do not affect the company's cash balance, and these are the components that account for the difference between the net income and the cash flow of the company for the last financial year. For example, it can be assumed that a company delivers goods to another company, but that the payment deadline for the goods is 60 days. This is booked as an income, but although it is booked as such, it is an income that does not mean that the cash balance of the company increases, for 60 days at least. The company's cash balance only increases the moment the company receives the money. Equivalently, if the same company receives raw materials that are to be processed into end products from a raw material producer, but does not pay immediately, this is booked as an expense in the income statement. This is a cost that is immediately noticeable in the net result, but which is not shown in the cash flow statement until the cash actually leaves the account. And this cost is also immediately included in the balance sheet as accounts payable. And this is the core of the difference between accrual accounting and cash accounting. The cash accounts post income when the cash is received, even if the cash arrives for goods delivered to the recipient in another accounting period. Correspondingly, costs are booked in the cash accounts when the cash is paid out, even if you pay for goods you received in another accounting period. But, and this is important, generally accepted accounting principles, GAAP, which is the auditing standard of all listed companies in the Western world mostly follow, do not use cash accounting in the income statement. Accrual accounting is used. Accrual accounting tries to match income and expenses to the most appropriate reporting periods, even if the cash from the booked income and expenses comes in or disappears from the company's cash balance in another accounting period. Accrual accounting is the main reason why the net result does not indicate a corresponding change in the company's cash holdings. And to close the gap between the income statement and the cash balance, companies publish their own cash accounts, whose role is to explain what proportion of the company's net profit comes into the cash balance, and where any discrepancies disappeared or came in from. A good example of this is depreciation that is not a cash cost. In the income statement, it is the share of an asset, for example, a machine that produces goods, that was used up in the previous reporting period to produce the income that was reported in the same period. However, the cash used to buy the machine disappeared from the company a long time ago, in a completely different reporting period. So, what does the cash flow statement do? It takes all costs that reduced the net results but did not reduce the cash balance during the reporting period, such as depreciation, and adds them to the net income to make the net income consistent with the cash development. This is also done with the income that comes from the income statement. If an item has been delivered without the company having been paid for the item during the reporting period, this is deducted from the net result in the cash flow statement. The counterpart to depreciation is capital costs. If depreciation is a cost that is deducted in the present for expenses that were paid a long time ago, then capital costs is cash that the company pays now to be depreciated sometime in the future. So capital costs are the cash the company invests in the operating operations today that will be consumed over time. So for every $100 the company spends in capital costs today, there is 100 less available to the owners of the business today. Therefore, some people like to distinguish between capital costs for maintenance and capital costs for growth. Capital costs for maintenance are cash the company is forced to use today to maintain current earnings. If the company, rather than spend this cash on maintenance, pays dividends to the owners, then the company's value erodes. Capital costs for growth, investments, are cash the company uses to increase the company's earnings. This is cash the company is in no way forced to use, and this is money one can rather pay out to the company's investors without ruining future earnings. The company may not grow if management makes this choice, but it will not shrink either. When investing, you should therefore attempt to buy companies with low capital costs for maintenance. High maintenance costs force owners to reinvest cash value just to maintain current earnings. What you are looking for are companies that have a high free cash flow, which the management of the company is free to consider whether to reinvest in growth or pay out to the owners in the form of dividends or repurchases of shares. And what is free cash flow? It is the cash flow from operating activities less capital costs for maintenance. The free cash flow is a useful way to measure how much cash can be returned to the owners each year. It's not a perfect metric, but it can be better than the net result. The net income is largely a construction from the auditing profession, with assumptions and subjective assessments. The free cash flow the company reports is a fact. Good companies give owners back large amounts of cash over time. Typically, they have high free cash flow and low capital costs for maintenance over long periods. And if you have endured reading so far, the main point of this text is, this is what you are looking for as an investor. When you peel away all the hustle and bustle, all the rumors and views about what the world will look like in 10 years. Ultimately, it is about getting back more money than you have paid into the company.